Okay, looks like we are all set here. So good morning, everybody. Welcome to Engineering the Markets. My name is Jared, and it is December 13th, 2022. So happy Tuesday. And as the title suggests, it's going to be kind of an interesting morning session. The market is on a preparatory cycle to somewhat prepare for the reaction that we're likely to see from CPI coming out. And for the purpose of this particular session, CPI will be released at 8:30 market time, so 8:30 Eastern. Engineering the market typically ends around that time, and I will be cutting off a couple minutes early just to prepare for the reaction and some of the trade involved with it. So let's talk about yesterday. Let's talk about some of the just overall market position into this particular data release. The SPX did see a rally on yesterday's trade. Took most of the morning session to kind of settle out that directional bias. And I would argue that there was some lack of strength in our tech sector. We were seeing some relative weakness in certain stocks, and overall just a lot of choppy intraday trade, nothing really of high advantageous trend until we got to the afternoon session. Some keys about yesterday's trade. We are rallying from Friday's close. So our SPX is somewhat mid-range between what's expected this week and the upper boundary of our expected move, which currently is at 40.61. But with this expected move, we are calculating that most of the volatility is going to fall within the next 2 days. And usually any sort of reaction from that will be seen on Thursday and Friday. When it comes to what type of volatility are we expecting, that's where the option market can really shine, because at the very least, we know what the option market is pricing for today, how much volatility has been sort of placed into the open interest contracts, and what does that implied volatility mean for us. For one thing, I would say that if you're looking at the SPX Tuesday series, so this would be expiring end of day today, the market is expecting about 100 points of volatility, plus or minus 97 mentioned here. And I would argue that most of that is going to be somewhat represented by the CPI reaction. We might see something akin to anywhere from like a $6 to $7 SPY candle off of the data being released. And then subsequently, if we see a directional bias from that reaction, anywhere from 90 to 100 SPX points wouldn't be out of the question. It would essentially be what the market expects by the end of the day. The way you can see this just more directly is you can often just grab at the money straddles. And this can be done in the SPX as well. The market closed at about 39.90 on yesterday's advance. And you'll notice that the price here, if I kind of move this over, maybe get more room, it's priced at about 104, 105. And this is based on yesterday's close. Some of this data is a little skewed based on the fact that we're opening this morning. You want to be careful using the current price, because for the most part, this market has been closed off since we saw yesterday's market complete. So all in all, the market expects about 100 points, and the SPY equivalently is showing about 7.5. Once again, I think the reaction itself, we've seen pre-market trade of the magnitude of approximately 6 to 7 of SPX volatility. So regardless of what our rally looks like from yesterday and just the current pricing of the market, you could argue that we could see SPY anywhere from about 410 to the top side and then back down to about 394 to the downside, plus or minus 7 in both directions. 410, a little bit of an exaggerated upside. Same idea here, though. If you're looking at yesterday's close at about 399, this is where the call and put premium is close to equivalent. It's within 50 cents at this point. The at the money straddles from yesterday were closer to about $10. And one thing the platform doesn't necessarily show is that most of that open interest is still within the market's option chain. Therefore, I would expect that type of volatility throughout the day. Essentially, reaction could be magnitude of about 6 to 7. Overall trade today could be anywhere from plus or minus $10. So once again, I don't really know where the market's going to open or some of the prices we'll see before the reaction, but thinking in terms of those magnitudes is going to keep you kind of on the right side of today's volatility, and also to expect the unexpected. Because remember, this is what the market would deem as a nominal or normal move today. This would not be out of the question if we saw something much larger. For the most part, it's going to be binary in regards to the reaction off the data, along with the subsequent trade. I will be looking for things like correlation to kind of hit the marketplace again. We saw that yesterday as the rally kind of came into the afternoon. And I guess I'll quickly show this before I shift over. That correlation oftentimes is indicative of a little bit of hedging. In this case, we did see the market rally, but the VIX was much higher. And to me, what this means is there's still some downside hedging taking place. There's people buying out of the money premium in probably a future market series or an option series, looking for the potential of a correction, something more dramatic to the downside. But the price moving higher means that there was probably some short covering as well. And this is kind of like a dual purpose trade. There is likely still a short presence in this market. I would argue that we're still seeing fairly low skew readings overall. But that doesn't mean that the shorts aren't necessarily fearful of a larger than average upside move, something akin to a blow off top over some of the trend lines that have been drawn in the SPY. So downside protection makes a lot of sense. We have a binary event, but short covering off of the range support also makes a lot of sense, both technically and also just because we haven't seen a ton of S&P movement except for last week. Last week was kind of that opportunity to maybe get short into some strength and prepare for the week ahead. So, that's kind of an explanation of yesterday's rally. Anytime you see correlation in the market, you often want to be thinking what sort of trade is going on and why is it affecting all stocks as opposed to baskets of stocks. Usually when it's that significant, that is more or less buying and selling of the futures products that correlate with the SPY. Something like ES, long or short, and it just depends on the type of correlation we're seeing. Obviously, there were some standouts yesterday. Stocks like Tesla not only didn't benefit from the rally, but also stayed near low of day the entire time, showcasing just how weak that particular relative weakness was on yesterday's trade. So as far as the CPI itself, And for the most part, I'll kind of keep towards the CPI theme. I figured today we'll talk briefly about some of the inflationary and recessionary themes, but I'll save a lot of it for Wednesday just because we're about to see some volatility that's worth trading. But as far as the CPI itself, what is the market looking at and what are the numbers? First and foremost, we have two divisions of CPI. We have things like core CPI and the inflation rate itself. Core often refers to the removal of food and energy from that basket of assets that's being calculated. And usually this is a lower estimate number because food and energy does represent some higher inflationary forces. So oftentimes you will see the market estimating this to be, somewhere around 6% this particular year. Year over year, the market is looking at 6.1 at its estimate. And remember, last CPI, we did see a slight reduction in both core and CPI itself. The previous reading at 6.3. There has been a slight downtick in CPI readings in general. The market is hopeful that this is beginning a trend back to, at the very least, some stability in what the monetary policy and the Fed's decision to increase rates is doing. And all of that is leading to, some of the bullish and bearish nature around this event. If we see core inflation, for example, in line or slightly lower than our estimate, that would, of course, be interpreted initially as pretty positive for the market. The Fed would once again have the main probability of increasing its current rate, Fed fund rate, to approximately a 50 basis point hike. And more or less, I wouldn't be looking too much at a shift in probability for tomorrow. I would more or less be looking at shifts in probability for February. More or less, this data should be adjusting things like next year's probabilities and how aggressively are we going to push towards approximately a 5% Fed fund rate, which is kind of the May objective at this point, to get to about 5%. The question is how fast and in what cycles. Are we doing multiple 50 rate increases, or are we looking at another 75 up and coming, just to curb short-term inflation? Additionally, I would also be listening for just the main CPI numbers. The inflation rate year over year for regular CPI or just CPI itself is set at about 7.3. We saw 7.7 last CPI out in October. And once again, it was October's numbers, but we got it in November. All of which, back in October, the numbers were for purposes of some of the conditioning around the report were actually somewhat cushioned or conditioned to be slightly lower. I'm not going to say it was massaged into that, but more or less the readings from last CPI, I would say, were a bit skewed. The market's expecting even lower readings, which could lead to a surprise. And this is where I think today's trade not only is based on the actual data itself, but I would argue the market's preparation for this reaction. One of the things we can benefit here is that we've looked at what the market is pricing for volatility. Being bullish or bearish is going to be a little bit more challenging without the data in hand. As I mentioned in the BBT chat room, I'm definitely looking for the opportunity of a rally point. I'm going to essentially let the data come out, evaluate where we're landing in regards to the reactionary drop or even the subsequent rally from it. And I'm going to be looking, for the most part, bullish. I think the range allows for a little bit more upside. We're not necessarily fully back tested yet in regards to our trend line. So that means that our upside target still has a little bit more room. And so long as the market doesn't flush this VPOC, which is essentially where 3 weeks of trade is centered, as long as we don't necessarily lose this area, I would argue that the market remains a bit upside driven. There's definitely potential to go higher. All that said, it really depends on if the data comes in lower or in line. If it is slightly higher, I think seeing that drop should be interpreted as a little bit of a pause and allow the trend to form. Because even a slightly higher reading breaks the model of a downtrend in some of the inflationary estimates. Anywhere close to last month's numbers, whether it be month-over-month or year-over-year readings, and based on the fact that last month's numbers were somewhat cushioned in how they were calculated, those readings coming back into more of a hot reading is not so much the bearish case for the Fed and for them to be more hawkish, but I think it simply means that the market is once again in a period of uncertainty. We're no longer seeing the data-driven clarity of downticks in inflation, especially month over month. So these kind of loose evaluations is mostly due to the fact that we're looking at some big volatility today. 10 points in the S&P is nothing to laugh at. It's definitely something you should be prepared for, and especially yesterday, the fact that the market is still hedging downside risk means that we could drop. The issue that I have with the drop is, one, we need to lose support. So we need to really get out of this trading range. And if we do so, the drop potential tears us down to probably the lower volume node, which would be pretty close in line to the weekly expected move, approximately 3807, I believe, in the SPX. Or if you're looking at the SPY, in particular, about 383 would be like the central point of the next volume node to the downside. If you're targeting something like the Qs, or you're just looking at some other products, I would kind of make this evaluation in a similar manner. I'm not going to walk through all of the volatility readings here, but for the most part, and this one's not even showing, so I'd have to probably grab the straddles here. 385. So about $9. Qs are pricing about $9 today. Yeah, somewhere within that range. I'm not fond of using the NDX for some of the expected move just because it's a lower traded product than the SPX. But you could also look here and see, based on the NDX, it's about 260 points of volatility today. We closed at 11,700. It's one of those harder to map out products, especially when you're trying to look at the NASDAQ. But for the most part, these spreads are pretty wide. It's not as heavily traded. You'll notice that the open interest is pretty nominal at this point. I mean, some of them aren't even traded from yesterday. So one of the main reasons I don't use this for the same evaluation is just because no one's trading it. You look at the SPX and those numbers shift dramatically, especially as you get closer to at the money. This is much larger participation and the spreads are much tighter, relative to the percentages. So all in all, those are some preparatory items. It's going to be hard to say bullish or bearish today. I'll be quite upfront. The idea here is knowing your risk, knowing how volatile the day is going to be, how wide we can see some of the reactions. We've seen this before, and remember, we've had 2 CPIs where the core intraday trade has been bullish. So remember that the market can go higher on these CPIs, even though we start with a sell swing on the reaction. Just remember, we've seen reaction trade and then day trade. You know, those are often different. They're not necessarily in the same direction. But more so, last but not least, is looking towards some of these weekly targets, simply because the marketplace is pricing most of this volatility today. You know, the FOMC is coming out tomorrow. That'll be another kind of shaker and mover type event. But for the most part, a lot of the expected move has been priced on today's session. And it's trickling into the weekly series for Friday, but we're likely to see most of the move today. And of course, if it breaks out of expected move, we'll see a little bit more dramatic price, especially if we're getting to the downside. So all in all, market's extremely data driven and sensitive to this. Prepare for the shakers and the movers today. Don't necessarily get trapped just because you see the reactionary candle and you think that it's going to go in that direction. We've seen a lot of traders miss out on opportunity because they have that bias, and prepare for, you know, some pretty big moves. So last but not least, as I mentioned yesterday, we're going to be looking a little bit at some market themes moving into tomorrow. And the objective here is to discuss game plans for 2023, to talk about what we've been experiencing as far as the last couple of years of market trade, what has been working, what has the market been rewarding and punishing, and how the market shifts themes slowly but surely into new cycles. If you've been joining, we've talked a lot about how 2020 and 2021 was kind of the year of expansion. There's a lot of speculation and high growth. Fundamentals were eroding underneath the hood, but monetary policy was lenient. And therefore, we saw sort of relative strength in technology and growth sectors, a lot of the cyclical names, and oil as a commodity, not necessarily energy stocks. Industrials also kind of led near the later half of 2021, as we saw sort of the reopening theme and a lot of additional money flow coming into, quote unquote, the system, along with the sort of tail end of the bull market for commodities. This year has been closer to that inflation theme, and you can certainly see down this list where the strength has been in the market. The market has moved away from what was working in 2021, and we saw a lot of risk inside of some of the most speculative names, and even as it kind of catered further into the 2022, we saw technology also leaning down, but new bull markets emerged. Energy stocks, consumer staples did have their time in the sun, and a lot of the value names are starting to make a little bit of a resurgence. Materials were also a key theme. This was a pretty big driver near the end of 2022. And more or less, some of the precious metals are starting to get some of that that high inverse correlation with what's happening with the dollar index. And then last but not least, bonds. And this is kind of what we started to discuss a couple of weeks ago, some of the stage one confirmations that the market is preparing for the contractionary cycle in the economy, but that also correlates to a outperformance in the bond market, which of course drives rates, and that kind of fits the theme of how the recession in potentially 2023, remember this is still somewhat speculative, but if we are entering into something of this nature, the next market cycles are going to be focused in on these particular industries: healthcare and pharma, packaged and fast food, tobacco and alcohol, and utilities. Not necessarily in that order, but sort of grouped as a number of sectors and industries to watch, especially if you're looking to have a portfolio that can weather something like a period of contraction, along with what the market tends to reward during that time, what it tends to be more bullish towards. So we're going to look at this more in depth tomorrow. Obviously CPI is in focus for today. I'm going to go ahead and cut off here just to give that extra couple of minutes to kind of get settled and prepare for what's about to happen. Be on the lookout for these themes as we enter into 2023, and we'll talk about the forces behind it and what to confirm or deny some of these in themes, because markets don't necessarily shift into them immediately. They often kind of cycle slowly into them, and usually it takes a little bit of convincing. So with all that said, we'll look at this tomorrow. Stay safe, trade safe, and we'll talk more then.
I hope everyone is having an amazing morning. Hopefully, you guys had an incredible day yesterday, or at least better than what the markets were. I notice I don't have one thing, Norman. That's why I can't hear you, and that is my headphones.
Oh, I
Give me
see your
1 second
ears.
while
That's
I
the
find this
problem.
thing. Where did I put them? Huh. Okay. No, we'll do this. Let's go over to community events and announcement. Nah, I'm sorry. To the overall market, and then I'll come back with my headphones here.
Yeah, it was really interesting. SPY, the markets overall just got a big boost of volume. We're still a minute away from the CPI data being released, which is the big info. Of course, the FOMC's meeting today and tomorrow. They'll take this data into consideration, what they do with their rates. CPI, core CPI, CPI X shelter, which usually is not at least mentioned that way, even though it's in the data. So we're expecting 0.3 month over month for both. Let's see what we get. Market should go crazy after this, one way or the other, I would expect. So Yeah, we've been waiting for it because trading has been squirrely the last couple of trading days. So especially yesterday, I was a little sad to see people grasping for some straws yesterday when a lot of there wasn't anything to make out of anything for a good chunk of the day. All right, we got 10 seconds, so let's see what we got.
That is so true, my friend.
Hopefully, Squawk has it fast. Market's popping on this, so lighter than expected.
All right, looking very positive right now as we're moving up here.
Okay, so core came in at 0.2 versus 0.3 month over month. And headline CPI month over month came in at 0.1 versus 0.3. So, yeah, that's good news.
All right, good news. And the market right now is definitely liking that, at least at the moment. So yeah.
So now our gappers list is just going to grow like crazy.
Yeah, it was pretty quiet, and now you can see here the gap upside of things is gonna be massive as things starts pushing through here. So let's give it a little second for it to kind of see where the rest of the action is going to take us here. But if you look at our gappers list, everyone, their mother and kids and grandkids are in this list today when it comes to tickers. So everybody's here, the whole gang. This is like the Christmas party where you have people you probably don't want to be here are there. So we'll see how we can dissect this list to pick out stuff that we actually can trade today. It's going to be a tough day. It's not going to be an easy one. And Jared spoke about this earlier this morning. Big shout out to Jared with engineering the markets, getting us macro type information about the overall market and the way things are, what to expect throughout the trading day and weeks to come. And here, guys, you can see that, again, just a whole lot of action happening with the SPY continuing to push higher. Quickly look at the stuff from yesterday. There was not a whole lot to see. This will be very quick. I had 3 tickers on my list: Tesla, Rivian, and Netflix. And actually, out of these 3, and you can see Tesla there now reacting to the news at the moment, up almost $9, $8 there. So again, it's just very nice.